Focus. Ideate. Innovate. Enable.
Hello and welcome to the final episode of NSE FinWiz, powered by CNBC TV 18 Season 3. Now, we've traversed across the country to 21 companies in an aim to impart personal finance knowledge to our viewers. As we get into the last set of investment values for the season, here's a look at our journey so far.
Starting our journey at Emphasis in Pune, we travel to Mercedes, L&T, Mahindra & Mahindra, TCS, Distillery, Wonder Cement and many more destinations. NSE FinWiz Season 3 circled around the complete personal finance gamut in the last 21 episodes.
Our core topic for today is the fundamentals of personal finance.
Look at your life milestone that you have, and that's very easy thumb rule to set up goals.
Tax planning or investing for tax purposes, tax saving purposes, should be an ancillary benefit.
Every 5-year delay will cost you double. That is why it is important that as soon as possible you start investing for retirement.
Like a reliable insurance policy, we hope that these lessons have been able to help you build a financially secure future for yourself. And join us today as we talk about the importance of insurance with the employees of India's largest manufacturer of lead-acid battery storage products, Exide Industries, in their head office in Kolkata.
The country's largest manufacturer of lead-acid storage batteries and power storage solutions provider, Exide Industries offers one of the widest range of batteries for every conceivable application in automotive as well as industrial segments.
And we're now joined by our two very special experts. We have Kalpesh Ashar, who's a CFP and the founder at Full Circle Financial Planners. Welcome to the show, Kalpesh. And we have Harshwardhan Roongta, who's also a CFP with Roongta Securities. Welcome to the show, Harsh. And our core topic for today is insurance. Harsh, when we talk about insurance, I want to start first with life insurance. Is it important for a person to have life insurance? And there are so many products out there in the market. What's some of the maybe 1-2 important points that a person should have in mind when they buy a life insurance policy?
Well, Sumit, when you talk about insurance, it's important to understand what is insurance. So let's understand a situation. There are certain events in life which could have financial implications on a person or his family. Now, which could be death of the earning member in the family, which could be illness and hospitalization, could be disability. Now, there are some kind of financial implications if there was a death of the earning member. How do you mitigate this risk? In case you're not there, how do you make sure your family still gets the income that you were generating and the day-to-day expenses of the family is taken care of? So, the process of transferring this risk is called insurance. The institution which takes this risk on themselves is called an insurance company. So, the process is very simple. We're talking about a situation which is going to have financial implication on the family, and you do not want that to happen.
Right.
So, you buy a product, you buy a policy, as it is called, which promises you that in case of an untimely demise, your family is going to be compensated for a particular amount, for which you have to pay a small cost, which is called premium. Now, having understood this, let's understand how important life insurance is. If you are the earning member of the family and you have dependents, imagine a situation where something happens to you. So there, we know death is certain. We do not know when it is going to happen. So time is uncertain. If it were to happen, how do you protect your family financially? Emotionally, of course, nobody can replace you. The process is life insurance.
Okay.
The best form of buying insurance is that you buy in the form of a pure term cover. So it's not a savings element attached to it. It's a pure risk cover. You pay a premium, you get a sum insured. If something happens to you, the family is given the sum insured. And if nothing happens, that is a cost that you have paid to protect your family financially. That's all.
Kalpesh, so Harsh says term insurance is the best form of insurance to buy. But people always come back and saying, term insurance, I'm putting that money and if I don't die in that period, I'll lose that money. Secondly, why not do a ULIP? So I'm getting my investments and my earnings together. So what's the thought on that?
So this is the most popular misconception we all have about insurance as a product. So when we say, and we have got it injected into our minds, that we are paying something, so we should get something back at the end of it. Now the word misconception why I'm using here is because taking off from the concept of insurance, which is protecting yourself against a potential financial risk, has no returns embedded in it. So just to give a simple example, I will probably draw an analogy from the concept of a health insurance, which is your mediclaim or when you're hospitalized. So you do that, say for a certain amount of 5 lakh or something like that. Now when you do that and you pay a certain premium in that, you wouldn't surely pray day in day out that for 11 months I haven't fallen ill and my premium is still like 1 month pending, so please let me get hospitalized. You will be on the contrary happy that you didn't get hospitalized, and what have you paid for it? A petty premium. So the same concept should be drawn to a life insurance, the term plan concept, that you paid for a protection of a larger risk which your family will incur if you are not there. Now coming to the question which Sumit asked, that the products which are embedded with the investment element in it are the products which are having a high amount of premium also attached to them. And when one and one get to gather there, it is not 3 but it is surely just 1. Because these are disguised products and the same thing. So even the word ULIP, if you were to break up the word, it is a unit linked insurance plan. And the units you are buying is straight linked to the market. And the same word we use in a mutual fund, which is you are buying units. So what's the big difference? And why should I club both the concepts together, which is insurance and investments? So to cut it short, the simple thing is keep insurance and investments separate. Insurance is for protection. Investments are for growth.
Harsh, this question is from Ashish Vyas, and he says, how do you make a successful claim in the case of a planned hospitalization?
Well, Ashish, it's very interesting that you've asked this question, because while the scope of cover is known to people, there are many a times that the claim is repudiated or it is delayed only because you've not followed the procedures. Now what the process is, the first thing is you should read the claim process in your policy document. By and large, the terms and conditions are similar, which is you need to intimate the company in advance. You need to tell them that this is the kind of hospitalization that you're going to go to, this is the surgery that you have been advised. There has to be a doctor's certificate advising you to undergo a surgery. So attach that with your intimation to the insurance company. When you do that, they will at least put on records and they know that on a particular date in a particular hospital the patient is going to be admitted. After that, you need to apply for a cashless. If the hospital is under the cashless network, you need to go and do the documentation with the hospital, take an estimate, go to your consulting doctor, take an estimate, get it attested by the hospital and send it to the TPA or the insurance company directly. So TPA is a third party administrator if they've been appointed by an insurance company, and you to send these documents duly certified by the hospital to the TPA for approval. What the TPA will do is they will examine the kind of claim, that the amount that they feel is appropriate, and they will sanction a particular amount and send that intimation to the hospital. After which you undergo your hospitalization. If there is a discharge, as and when there is a discharge, you collect all the original receipts because there is a difference that you might have to pay. So whatever difference that you pay beyond the approval amount is what you need to collect the receipts for by yourself. The approved amount, which is under cashless, will be sent to the TPA directly by the hospital. You need to submit all the documents post hospitalization within a specified period. Some companies have this period of 7 days, some have it up to 30 days. That you need to check in the policy document which you have, and then submit all the documents within those time periods. One interesting point, Sumit, which I'd like to highlight is, while the policy document prescribes that you need to submit all the documents within a particular amount of time, in case there is a delay, IRDA has very clearly informed all the insurance companies that you cannot reject a claim merely because it was sent late. So in case of a situation where you've not been able to submit the documents within 7 days of hospitalization, don't be disheartened. If the reason is genuine, you should be filing and you should be claiming the amount from the insurance company, and don't ever fall to that kind of a tantrum that they throw that you've not given the documents within time, so we will not pay you. Flash the IRDA regulations to them, very clearly telling them that they have to pay you even if there is a delay beyond 7 days or 30 days, if there is a genuine reason.
On that note, it's time for a very short break. Don't go anywhere. We'll be right back. Welcome back. You're watching NSE FinWiz, powered by CNBC TV 18 Season 3. Kalpesh, when we talk about mutual funds, it's a general perspective that mutual funds is only for equity. But that's not true. Mutual funds can get access to the debt market, so which is, you could say, equivalent to fixed deposit for ease of understanding, you could say. So, could you tell us a little bit about that? Why is it beneficial to again use the mutual fund route to invest in the debt market?
Okay. So, there's a different category apart from equity, which we call the debt-based mutual funds, which is nothing but your fixed income securities. And when we say equities and debt, it automatically sums up into something called a balanced portfolio. So it is not that you are only looking at one type of a product. You are looking at something different also. So for a simple terminology, it could just be risk versus non-risk. It is not elimination of risk, it is lesser amount of risk. So when we say fixed income products, which we would like to know about, so a simple product which comes to every person's mind, if you don't know mutual funds, is your conventional bank FD. Now we are seeing that your bank FD's rate, because of the declining interest rate scenario, your bank FD rates are coming down by the hour or by the month, I would say. So that is not a happy place to be right now. So when you invest, like what Harsh was explaining, in a host of equities, in an equity-based mutual fund, a similar concept is drawn out by the fund manager while purchasing different fixed income securities and making a debt-based portfolio. So if you have a larger term horizon of investment in debt, you would buy government securities of 10-year and 5-year and 15-year term horizons. If you have a shorter investment time horizon, you would buy the treasury bills, 6-month paper of the commercial paper which you have, or you would go into small corporate FDs. But here it is a mixture of all the fixed income securities. There is no element of equity in this. So the returns also, you all should be reasonable in expecting when you invest in debt that it is going to be in a fixed range. It cannot be like a pendulum swing like an equity. So it is going to be in a fixed range, and the final point, it has got an element of risk because of the interest rates, because of the various, even the credibility of certain papers which are there in the mutual funds. So those are detailed things, but there is an element of risk. Probably, I would say around 3 to 5% of a risk in a debt-based portfolio also.
I have a term insurance where I know that I'll not be getting any returns. It is just for security purpose. But of late, I've come to know that there is a new term insurance where if I invest, then later on I'll be getting some money out of it. The premium which I'll be paying, I'll be getting it back. So what is that about?
The policies that you're talking about, the plans that you're talking about, are called term insurance with return of premium. So they're nothing but all the premiums that you've paid over a period of time,
yes.
And if nothing happens to you, the premium is returned back to you without any gains on it.
Right.
However, when you compare the premium amount, it's going to be almost 3 to 4 times of the regular premium that you pay for a term insurance. Now you need to do the math. Why are you buying an insurance policy? Now take for example, if you're paying a 10,000 rupees for a 1 crore life cover, wherein nothing comes back if nothing happens to you. Or else you pay a 40,000 rupees for a 1 crore cover, and you get that 40,000 into the number of years just simply back in your hand. Wouldn't you be better off investing the 30,000 rupees on your own and making sure that you get that money back in your hand? The second point you need to keep in mind, if something happens to you in the next 30 years, you have paid 4 times more premium for the same cover. In case of demise, the premiums are not returned back. The premiums are returned only in case you live up to maturity. Okay. So if something were to happen to you 5 years hence, you have paid 4 times more premium for the same cover. And what is the value of money going to be? The premium that you paid just by itself, the principal amount after 30 years maybe. So the efficient manner is that you buy a term policy and simply consider it as a cost and not look at anything. These products are developed because of a mentality that people don't like nothing coming back to them.
Right.
So they address to one set of audience, which is fine. But if you are efficient enough and you are smart enough to buy a term policy right now, I don't think you should look at moving into a return of premium policies.
You're watching NSE FinWiz, powered by CNBC TV 18 Season 3. It's time for a short break. We'll be right back. Welcome back. You're watching NSE FinWiz, powered by CNBC TV 18 Season 3, and today we're shooting with the employees of Exide Industries.
Does this insurance return depend on how the person is dying?
Well, life insurance products, there are different forms. The first one is, of course, death due to any reason, including suicide after 1 year of taking the policy. So what it means is, when you bought a life insurance policy, and even if an individual commits suicide after 1 year of taking the policy, the coverage amount is paid to the family. Now, there are certain add-ons that the insurance companies provide you. Like in case you wish to add, a death due to accident. Okay, so there's an accidental death rider which you can add into it at an additional cost. So which goes on to say, if death occurs due to an accident, then the sum insured which you've taken, say for example 1 crore, and an accidental benefit which was 1 crore, both are going to be given to your family. So that is 1 crore plus 1 crore becomes 2 crores. But the underlying condition is that the death should occur due to an accident only. If death occurs under normal circumstances, non-accidental, then only the sum insured, which is 1 crore, is paid. So you can enhance the cover in case you feel that there is a specific risk to yourself. If you travel a lot to work, if you're on field, if you're a marketing executive, and you are required to go to different companies, and that's your job profile, that you need to meet your customers, and you know that you're going to be traveling on motorbikes and you're going to be using public transport for that matter, then you may want to add an accidental rider in your policy.
For someone in the age bracket of 40s and planning for retirement, what would you suggest as an ideal retirement plan, including all kinds of products, maybe mutual funds, SIPs or equities or FDs? How would one go about it?
When you do retirement planning, first of all, we need to understand what is the type of a corpus which you would require. And it all depends basically on, first of all, your present set of expenses. And the calculation is thus done that even if you were to maintain a status quo, that your expenses probably would remain the same. Obviously, everybody would like a little bit of an elevated retired life. But even if you were not to be too optimistic and say that I want to maintain the same status quo, and for the next 20 years, what would be the inflation hitting these expenses? That's how you would come to arriving at a retirement corpus. Now, once that retirement corpus would be arrived at, and believe me, it looks a very scary figure for anybody. So, you need to look at that and then accordingly allocate your assets. One important thing there are certain other goals which would come in that years also. So probably if you're 40, you wish to do your retirement planning, at some stage you would also be having in the next 3 years your child's higher education coming. Probably 7 years after that, the same child would be getting married. So you would also have to simultaneously plan for that. And in that, so if it's a 3-year time horizon for an X goal, the investments would be in conservative. You don't want to take a risk in in that short time frame. So accordingly to the goals. So simply speaking, if it's a 20-year time horizon and there's nothing in between, the simple answer would be around a 75 to 80% type of your allocation towards equity, and 20% just to keep the balance intact would be in debt. So this is not a thumb rule, but I'm just giving probably a small roadmap for you to commence.
If I have a moderate to high risk appetite, what portfolio or what investment option should I be looking for?
There are several parameters which you design a portfolio. One is, of course, what your requirements are. When is that requirement going to be, so which is the time horizon. You need to also define your own risk profile. So while in your case, Tarun, you said your moderate to high risk profile, very clearly you should have more exposure to equities. Now within equities also, there are high risk equity investments. You could start with a small and a mid cap funds. Okay, they have the potential of going up, much faster than the large cap ones, but at the same time, they go down also equally faster. So because you have a moderate to high risk profile, you could bet some bit of or a large part of your money into small and mid cap funds. You need to have some portions into large caps, of course, because they will form the core portion of your portfolio and you will be invested into one of the best companies in the country. So while you talk about moderate to high risk profile, I would say, without knowing all your goals and the time horizon, I would say you could look at even investing up to 80 or 90% of your money into equities. Within equities, as I mentioned, you can go into, a larger portion could go into mid and small cap companies, and, moderately amount could go into large cap. So this is how you could begin thinking about it. But do keep in mind, your goals have to be aligned with your risk profile. You may have a very large risk-taking capabilities, but if your goal is just 1 year hence from now, you need to cool down. You need to come back, because your risk capability does not alter your goal. You still need the money after 1 year and for a particular purpose. Even if you take the risk, you might not meet the goal. So just align your risk profile with your goals also.
Well, on that note, thank you so much, Kalpesh. Thank you so much, Harsh. Thank you so much for having us here.
It's a fantastic initiative because it made money easy. We thought that, it would be very advanced in terms of terminology, and they actually made it very relevant in terms of answering all our queries and questions.
With the plethora of information today available in the market, it becomes very confusing for an individual to actually decide on the investment plans. So we got a very good idea about, what are the various asset classes where one could invest. And I think the key takeaway for me was that the early you start, the lesser you actually need to shell out to get your targeted corpus. So I'm definitely going to personally go back and relook at my investment portfolio.
Well, that's all on the third season of NSE FinWiz, powered by CNBC TV 18. But with a promise to keep educating you about the mantras of personal finance, we're signing off from the City of Joy. Please do subscribe to our YouTube channel and also log on to our website so that you can keep updated on how best to manage your personal financial portfolio. From the entire team, many thanks for watching.
Focus. Ideate. Innovate. Enable.